Hmm.
Hello, everyone. Welcome to this webinar. Thanks for joining in. Uh, every quarter, we try to decode how the earnings been for the last quarter. And as the agenda of the webinar states, we'll try to decode how the earnings have been for Q1 FY26. What have been the winners, laggards, and what lies ahead in terms of outlook for the next few quarters going ahead. So, before we delve into how the earnings have been, we'll try and demystify in terms of what has been the backdrop against which these earnings panned out on a earnings panned out. So, to start with, credit and deposit growth continue to remain weak over the last first quarter of FY26. The dollar index continued to moderate. Usually, uh, whenever the dollar index goes down, it is positive for flows into emerging markets. On the back home contrary, the quarterly GDP growth has surprised on the upside with Q1 FY26 real GDP growth came in better than expected as compared to the previous quarter as well as the Q1 of FY25. Whereas core inflation, headline inflation continued to moderate, supported by significant moderation in food prices. We also saw recently the S&P upgrading the sovereign rating for India from triple B minus to triple B with a stable outlook. So overall, the overall Indian macro environment remains stable and strong, and hopefully we should see better earnings growth in the coming quarters. So, in order to try and understand how the earnings have been, which segments of the markets did well and which did not, I'll hand over the webinar to Harshad Borwake. Mr. Harshad Borwake is Head of Research at Mirae Asset Mutual Fund. He's also fund manager. So, welcome, Harshad. Over to you.
Yeah. Thanks, Renik. Can you just confirm if I'm audible?
Yeah. Please go ahead.
Sure. Okay. So let's start. Welcome all to this webinar on 1Q FY26 earnings season. So yeah, we completed season on 14th of August. So just completed 2-3 weeks back. So let's start with first few headline numbers. So if you look at Nifty earnings, EBITDA growth of roughly around 10% and PAT growth of roughly around 8%. So mind you, this comes on the back of weaker FY25, as you can see in the top charts, top left and top right. So there is a single digit growth over the last few quarters. The only respite in this quarter was it is slightly better than I would say last 3-4 quarters. Some uptick we are seeing, and also if you look at in terms of how the numbers were versus the expectation, so there was a decent beat I would say for Nifty 50 companies. So 48% of the companies reported better than expected numbers. This, if you look at average for the last 4 quarters, was at around 28%. So yeah, clearly, 1Q was slightly better than expected. Going forward, if you look at headline numbers versus 1 to 2% growth in FY25, the consensus Bloomberg estimate states that FY26 earnings could grow at around 8 to 9%, and FY27 around 17% or so. So towards what we'll do towards the end of this webinar, we'll see how this earnings growth is coming through for both FY26 and 27 on a full year basis, while obviously we are focusing more on the quarterly numbers today. Yeah. So as we move forward, so this is just a a collage of what we are trying to do. Look at all the transcripts of the earnings during the 1Q FY26, and what all pops out. Which are the common themes which were there during the quarter. While it's quite I would say mixed kind of a slide, but that's what we'll try to do. We'll try to as title suggests, try to decode or decipher in terms of how the earnings have moved, and we'll do it sector wise on a more structural basis. So versus headline, we looked at Nifty 50. We will broaden our investment horizon, our investment universe, and look at more on a BSE 200 basis rather than just on a Nifty 50 basis. So if you look at the BSE 200 earnings, just focus on the last two columns, which is more one last column is basically the weight of each sector in the BSE 200 index, and the second last column is how the performance of this sector has been for the current quarter. First, we bifurcated first, financials, which includes banks, NBFCs, and insurance. Consumption, which is quite broad-based. It includes discretionary, which is also auto, then FMCG, retail, then also real estate, building material, durable spends, telecoms, etc. Then we look at export-oriented sectors like IT and pharma, followed by global sectors like metals and oil and gas, and at the end, look at domestic focus investment sectors like cap goods, infra, logistics, cements, and utilities. At a headline level, if you look at the numbers, yes, there was a moderation in terms of performance for the banks. Story continued what it was in the previous quarter, fourth quarter. NBFCs looked better at a headline level, but primarily that is because of power financiers, mind you. Ex of power financiers, again NBFCs were kind of a mixed performance. Autos was weak. Consumption, again, as we said, there are multiple subsectors within that. There was a mixed trend. Export also was weaker, but net, if you look at BSE 200 profit growth, again, similar to Nifty 50 here to slightly better. If you look at aggregate profit PAT number was up around 10%. If you look at the last few quarters, focus on the last row, shaded in gray. So versus a single digit growth on a YY basis for the last few quarters, this quarter we saw 10% kind of growth. So I would say again slightly better than the previous quarters. Now let's start at a sector. So let's first start with banks. The banks again, story similar to the last quarter. At the headline level, loan growth is around single digit, or higher single digit or lower double digit, 9 to 10% growth both on the loans as well as on the deposit side. The retail deposits continues retail loan growth continues to be higher at roughly around 12% or so. I would see 1Q for banking sector more as a transitional sector. Here, as you know, loan growth was decent, but again there is a mismatch in terms of the passage of the lower interest rates. So NIMs contracted during the quarter, led by faster loan repricing, whereas and loan repricing are obviously faster than the deposit repricing. CASA ratios also fell, so to that extent there is limitation for few banks in terms of how much they could lend. Small finance banks, we saw some stress, particularly on the MFI portfolios. They did see margin compression as well as higher credit costs. GNP number, however, but at headline level, not much of a change. I think remains quite steady. Only issue is more, on the unsecured front, which across the banks is not, alarming, but it is still one needs to watch out for. From the outlook perspective, I think the near-term pressure will be there on the NIMs. Shrenik, we are still on the banks. Yeah. So the outlook pressure on the NIMs, will be there, I think, also for the second quarter. But in the second half, we do believe that recovery is expected on the NIMs front, particularly driven by various government initiatives or RBI initiatives, and also if you look at benefit of CRR cuts, easing rates, and also on the liability side, we should start benefit accruing for the banks. I think FY26 particularly, one can look at, so what we are looking forward is, from the portfolio point of view, where, there is a liability strength, credit exposures are relatively lower for the unsecured piece, and also there is some benefit on the treasury side. If you look at last 6 months, yes, the sector has relatively done well, but I think valuation still offers comfort, and to that extent, ROE profile is tracking much better, in terms of versus the long-term averages. Now let's move on to NBFCs. NBFCs, as you know, again, is not unlike banks. It's not a single sector. It has each NBFC is focused on different subsectors, and there is also multi-line NBFCs. But overall, if you look at AUM growth, roughly at around 16% or so, similar to last quarter. Within that, gold did much better at around 42% kind of growth, while MFI continued to decline, led by its own stress. NII, I think, if you look at NII growth versus the loan growth, I think only in two sectors we saw NII slightly trending higher than loan, which is in the housing finance and on the gold side. NIMs, I think divergence, across the NIMs, so there is not a clear-cut trend on that side. But yes, we saw some asset quality issues on the vehicle finance side, particularly because a single vehicle owner where there was a lower utilization because of early monsoon or so. Tractor demand continued to do pretty well. NBFCs with MFI focus showed some improvement at a par levels or at the collection. I think barring Karnataka, things are getting better. Diversified lenders did see some stress on the small secured MSME, LAP, and on that front. Going forward, I think, see, the question is, going forward, we need to watch out for obviously asset quality improvement on the unsecured side. If you look at recent stock performance, again, it was mixed. One needs to be stock specific. Our focus is more, on the NBFCs which are backed by the strong parent, and as well as which has a strong asset quality history. Yeah. On the insurance, again, bifurcated both into general as well as life insurance. So first on the general, so if you look at industry gross premium growth, which is around 8%, which is seen on the bars on the top left side, the bar which is showing 8% growth versus 2% growth in the fourth quarter. Change in gross premium, primarily, the moderation is for the non-motor side, shift towards the one by N accounting. Motor was steady, mainly driven by renewable, while new vehicle sales, as are again still continue to be lower. If you look at profitability, or let's say combined ratio, so combined ratio has been, I would say, steady for a multi-line private insurers. While standalone Sahi, or standalone health insurers, combined ratio was higher due to higher claim severity as well as higher claim frequency. On the outlook front, I think I would expect a mid double digit kind of outlook. Combined ratio is expected to improve, led by better pricing on the commercial line front, and also low nat cat, or natural calamity losses. Also, we expect price hike. The market expects a price hike on the motor third party, along with some benefits. If there is a reduction on the GST front. Valuations, I think, still are comfortable at around 25 to 28 times for private multi insurers. If you look at life, the growth was at around 8%, better than fourth quarter FY25. The pitch continues for non-par, or I would say traditional non-par and traditional products, while ULIP demand dropped due to primarily again due to market capital market volatility. Agency growth continues to remain calibrated, while banca saw better trends as lower interest rates obviously led to focus on the higher guaranteed savings product sales. Coming to value of new business growth, which is called as VNB growth. So in the 1Q, it was better at around 13% versus what we saw 8% in the fourth quarter. If you look from the outlook point of view, the growth expected is roughly around 14 to 50%, slightly tapered down from earlier expectation of 17 to 18%. Margins can see uptick primarily because of lower base and shift towards high margin protection products. If you think from the valuation point of view, I think 1.7 to 1.9 times price to EVs on a 2-year forward basis. So I think its valuations again similar to general are comfortable, but what we prefer is general multi-liner insurers versus life insurers. Now, coming to consumption, let's start with auto. So again, tractor, as you know, has been doing well. X of tractor, if you look at all other lines, largely negative to flattish on a YOY basis. On the two-wheeler side, I think there was some modest recovery which we saw during the quarter. Passenger vehicles, I think the premiumization trend continues, particularly on the SUV front. Because of premiumization, the revenue trend was also better on a PV side. Diversified auto ancillaries, if you look at, primarily were supported by CVs and tractor. But I think the margins did fell for them because of raw material headwinds and also because of weak global markets. On the auto ancillaries, on the tire side, if you look at, I think, strong revenue growth but muted profitability during the quarter. If you look at the falling rubber and crude prices, the trend which we are seeing of late, so we do expect tires, that there can be some margin recovery in the second quarter. So from the outlook point of view, let's say, not near term, but more on the 1 to 2 year perspective, there is expectation, obviously, there is on the GST rate cut front. So I think that to some extent, so if you look at the top right, bottom right side, so we have given, expected the current GST rate. So there is some expectation that the GST rate should reduce for, I would say, low-end two-wheelers or PVs. Also, there is some expectation of tractors, but we don't know what could pan out. But yeah, there is a hope that demand should revive, led by this GST rate cuts. X of GST rate cuts, there are various initiatives, including interest rate cuts, direct tax relief. Monsoon is also better, and going forward, the 8 pay commission. So there are multiple factors which could drive the demand revival on the auto front. So if you look from the 1 to 2 year perspective, the expectation on the PV side is that while the premiumization should continue, but we should move towards double digit volume growth. On the two-wheeler side, again, expectation is from the higher single digit to double digit volume growth should continue. Tractors is expected to grow at a decent pace, driven by the good sentiment on the rural front. Obviously, companies which would have new launches, especially on the SUVs and EVs, I think are expected to gain market share. And on the ancillaries, I think last point on ancillaries, I think whoever is exposed on the export front, I think could be some near-term weakness because of what is happening on the tariff front on the global side. Yeah. So moving to FMCG, I think on the FMCG things, we did see demand trends, improving during the quarter, particularly on the urban front. We saw pickup. There are some green shoots which are visible on the urban. I think rural has been doing well, but overall, I think the rural growth continues. On the paints front, I think primarily because of early monsoon, we saw some lower the paint kind of impacted during the quarter. Uh, for the I would say on the liquor industry, some states there was some favorable state excise law, so which has given some boost for the liquor consumption during the quarter. But net similar to what we said for auto, there are multiple factors which will drive the overall consumption growth, and to some extent, not as much as to discretionary, but to some extent it should also benefit FMCG as a whole. On the margin front, if you look at the bottom left table, so there we have looked at different RM basket, how it has moved. So if you look at QOQ, the one which are highlighted in green, so that is where we are seeing RM prices falling down. So to that extent, margins are expected to improve for the FMCG as a pack going forward. So also, yeah, as you know, in the last 1.5 year, there are new emerging channels in terms of for the particularly quick commerce, and also to that extent, to some extent, that is also benefiting consumer businesses as a whole. But from the valuation point of view, given the rich valuation, if you look at our own, so we are kind of underweight on this sector, primarily driven by valuation. But otherwise, earnings outlook looks much better. Retail again, multiple sectors within retail, so apparel, jewelry, QSR, footwear. But overall, I would say the demand weakness continued again in 1Q. If you recall, FY25 retail was one of the sector which kind of drove the earnings downgrade in FY25. So to that extent, I think even on the 1Q, we saw weaker demand. But I think what we saw is that there was some offtake driven by wedding demand, and also value fashion continues to do well. Jewelry did well, and grocery retail to some extent outperformed. On the outlook front, I would say again multiple factors. I will not repeat, but there are multiple factors which are expected to drive overall consumption growth, and to that extent, we expect second half to be better also for the retail, starting with the festive season. Moving to internet again, while it's a quite a varied kind of a sector, but in terms of food delivery, if you look at YOY, overall value growth of roughly around 17%, tax rate continues to be largely similar at around 21 to 21.5%. QSR, while it is slightly, I would say, subdued versus what we saw from versus the platform players. So QSR has been improving over the last 2-3 quarters, but still away from the historical highs. Quick commerce continues to remain strong, led by aggressive store expansion as well as SKU expansion. On the beauty front, the company continues to reinvest to drive overall growth on the beauty segment. Digital payments, as you know, the story, strong digital adoption continues in India. So the share of digital has continued to remain high over the last few years. So on the real estate, again, we have clubbed it, in terms of consumption. So momentum has slightly slowed on the real estate. So value has driven the overall growth vis-a-vis, volume. Volume has been subdued. So as per prop equity, if you look at sales in the top 7 cities, it was down roughly around 6%. But for listed players, the sales were up around 21%, and that was primarily driven by one, South players. But if you exclude that South player, even on the listed players, trend was similar to overall market, where there was, the marginal decline. But I think the launches have improved for the overall for the industry. So we need to watch out, in terms of how the demand pans up for the new launches. If you look at debt for the real estate company, so it has reduced, in the current quarter. That is primarily driven by capital raises and some sequential increase in the project additions. From the outlook front of view, I think the demand for now is steady. Valuations also, after the recent corrections, are reasonable. But I think we need to watch out when there is second half of this financial year is expected to be launch heavy. So to that extent, how we need to see how it pans out. So I think sector call is we need to be more stock specific, as you know, because the story for each city is different. So one has to take a stock specific approach here. Moving on to for durables, I'll wrap this quickly. So I think within that the story was wires and cables did well, but I think the main issue was on the cooling products because of early monsoon at the end of May or so. So we saw cooling products. It's a washout quarter for these companies. There was a lot of inventory which piled out. So to that extent, results were also very bad. If you look at building materials, so again, in building materials is the late cycle beneficiary of new real estate launches. We are yet to see the demand for building materials to come up. Our expectation is it should happen over the next 12 to 18 months. The demand continues to remain weaker during the quarter. One of the reason, obviously, I think as we see inflation as it starts moderating, we should start demand coming up for this sector, and also the shift from unorganized to organized should help the sector. But for now, 1Q, as which went by, was a weaker for the sector. Telecom, I think sector continues to do well. If you look at from the first quarter point of view, also there was one extra day. So to that extent, the ARPU was slightly better. Subscriber additions, again, net addition roughly I think around 8 million or so, decent subscriber addition. Data consumption also continues to remain very strong. At a sector level, if you look at revenue for top three players, which was roughly around up 16.5% on a YOY basis, 2.5% on a sequential basis. ARPU, obviously trended higher for top two players. Going forward, I think while obviously whenever the tariff hike will be there, ARPU will improve. But X of tariff hike, we expect ARPUs to improve, led by higher data subscribers within the mix. I think highlight for the quarter was EBITDA margin improvement. I think decent improvement over the quarter on a Q on Q basis. If you look at incremental EBITDA margin, the top player, it was almost to the extent of 75 to 80%. 5G penetration continues. It is roughly now at around 40% or so. And I think the broadband penetration is also continues to be higher. And I think going forward, we should see both ARPU increase and better broadband penetration to drive the overall earnings growth. From the valuation point of view, obviously, I think the sector or the top two players, I think, are decently valued for now. So incrementally, we see more this as a compounding story and also a deleveraging story. So now shifting gears and moving to global sectors. So let's start with IT. So IT, as you know, is going through headwinds. So I think largely, if you look at, we are largely cautiously optimistic. If you have to summarize, the way we are looking at this sector. So cautiously optimistic. 1Q FY26, the because of uncertainty owing to tariff announcements and all, so the growth was slightly subdued. But within that, tier 2 IT companies did much better vis-a-vis tier 1 for different factors. If you look at client decision making has taken a backseat. If you look at kind of projects, so the projects are more of a cost takeouts rather than transitional projects. But within that, I think the BFSI continues to do well. Sectors which are not doing well are manufacturing, retail, healthcare. If you look at top 4 players, I think these three account to roughly 40-44% of revenue. So to that extent, obviously, things will be weaker. Gen AI, I think we are early days of disruption happening primarily on the pricing conversations and revenue realizations. If you talk from the tier one companies perspective. Uh, CY25 for now looks to be muted, primarily driven by this tariff counts. The hope is more on CY26, where hopefully things should settle down on the tariff front. From the valuations point of view, I think sector continues to trade at a long-term average. History suggests that whenever there is a rate cut, particularly in the US, so to that extent, sector should benefit. But overall, I think structural positive. I think we'll have to wait for this year end or till the time the tariff issues get some sanity or clarity on that. Now let's move on to pharma. While I think the US growth momentum did slip, in 1Q. One of the primary reason was also one of the key product where sales were down for Revlimid, and also the higher base was one of the factor. If you look at the new launches and volume growth, so that to some extent did help to negate the impact of Revlimid, but nevertheless at a headline level there is a negative on the US front. If you look at X of US, on the other geographies sector, did a decent. I think it was reasonably well, if I have to put it. The domestic growth for most of the companies continues to remain steady, with pricing contribution being major part, as volume growth is kind of a low single digit. Chronic therapies continued to outperform, while acute focused companies saw some marginal revival. Within that, I think if you look at our portfolios, we are slightly CDMO heavy on the pharma front. Coming to healthcare, I think despite seasonal weakness, the growth momentum continued. If you look at RPOB, I think growth continued, primarily driven by better case, or I would say payer mix on this front. Again, coming to hospitals, I think despite better bed additions, it's almost up 7% YY. Occupancy continued to remain stable, while the average length of stay, ALOS, what we call it, was improved roughly around 4%. Margins were stable, as again, for the sector. On the diagnostic front, companies continue to report, I would say, low double-digit kind of growth, primarily driven by volumes, which are around higher single digit. And while most online players now have curbed their discounting, so to that extent, pricing pressure has, come down. So overall, I would say diagnostic was also stable, during the quarter. So moving to metals. Yeah. So metals, I think, again, metals, let's bifurcate in both into, ferrous and non-ferrous. But if you look at the EBITDA margin per ton, for the ferrous at least, so it did improve on a sequential basis, both supported by realization, as well as, realization again were supported by some safeguard duties, which government has put. On the non-ferrous side, particularly if you think from the Novelis margins, so they were down on account of some down on account of US tariffs and elevated scrap prices. Currently, I think sector, as you know, is more has been always been a short-term focused, or so to that extent. Current spreads, I think there is some margin pressure for the steel companies, primarily driven by uptick on the RM side. While on the aluminum front, I think on a YTD, prices are up roughly around 5 to 6%. But again, we need to see how the trend continues. In near term, I think the non-ferrous should do better than ferrous. Yeah, oil and gas. I think again on the oil and gas front, So OMCs, while the marketing margins were better, but the GRMs were lower. So to that extent, there was some drag. I think the highlight for the OMCs were more about government announcing that they would compensate for the LPG losses, which were the big LPG losses for FY25. So to that extent, I think that's a positive news flow. And as you know, for the OMCs particularly, more than operational thing, it is more about sometimes how these policy matters are taken care of. Coming to upstream, you see realizations roughly at around 66 $67 per barrel. So prices were down 20% YOY, 10% QOQ, but largely I would say results were on the expected lines. On the gas realization front, the realizations were up around 9% on a sequentially. CGDs or city gas companies, volume growth, single digit margins did moderate. On the gas utilities, I think there was a decline in the volumes, primarily driven by higher LNG prices, which impacted demand for refineries, petchem, fertilizer to some extent. Sector call, I think, given the disruption and also given the intervention from the policy front, continue to remain underweight on this front, and it will again similar to metals will be a more of a tactical sector. Now moving on to last few sectors, moving on to cap goods or utilities. I think so. If you look at cap goods, I think order inflow was better than expected. Private sector, while I think this private sector ordering was sluggish during the quarter. So if you look at segments which did well was power, T&D, renewable energy, data centers, real estate, and to some extent defense. The sectors which, or the ordering which was quite weaker or absent was sectors like cement, steel, petchem, sugars. There was a weakness on that front. Even on the even on the exporting companies, there was some weakness because of geopolitical issues. What we saw. If you look at utilities, again, power demand dipped. If you look at on a YOY basis, it was, I think, down roughly around 1.5%, primarily because of higher base and also early monsoon during the quarter. But here, I think, to the large extent, earnings of the power utilities is ROE driven. So to that extent, there will be less impact for them. Activity continues on the utility side more in terms of adding renewable capacity, and also I would say there is a decent activity happening on the transmission network. I think there is expectations of almost 9 trillion kind of ordering or spending which could happen on the transmission side by FY32. From the outlook or valuation, I think a lot of froth in the sector has reduced. But again, we need to be very selective, and stock specific in this sector. Yeah. Moving on to cement, again, seasonality and early monsoon kind of or reduce the volumes versus lower double digit. We moved to higher single digit during the quarter. If you look at the pricing perspective, I think all India cement prices moved up roughly by 6 to 7%, but within that, south and east region was sequentially better. From the profitability point of view, EBITDA per ton did grew, meaningfully during the quarter. Here again, similar to other sectors, there is some expectation which is built in terms of, GST cuts. So let's see how it pans out there. From the outlook point of view, overall, I think the expectation is FY26 will be around 6 to 7% volume growth. The pricing discipline, I think, is back into the sector. So to that extent, I think the profitability should continue to do well. Fuel prices for now has been range bound to the last few months. So to that extent, I think profitability should be better. If you look at valuations, I think if you look at top 3 4 players, valuation is trending between 14 to 18 times FY27 EV by EBITDA. I will not say cheap. I think they are decently priced. Here again, because the pricing discipline has come back, so we expect the sector. We are decently placed in the sector across our portfolios. So that was largely, at a sector level. So let's see, how, let's try to summarize, let's try to see what, we expect going forward, or how the things are, panned out. Yeah, I think before going to earnings, I think this is the important issue one needs to tackle, which is, elephant in the room is the tariff. Let's look at few numbers and get some perspective, where we stand. So now, as you know, at a headline level, India tariff has moved up to 50%, but obviously this 50% is not applicable to, all the sectors. Some sectors are exempted from this tariff. So to that extent, if you look at effective tariff rate for India, I think stands somewhere around 30 to 33% versus headline 35%. If you look at India exposure as a percentage of GDP, if you look at, I mean, adjust for this exempted, it is roughly around 1 to 1.5. I mean, exports to US roughly account to 1.5%. So from the impact point of view, while it is not too big, but obviously it would impact to some extent in terms of our growth numbers. So the if you look at various economists estimate, they do expect the impact on the GDP to the extent of 0.4 to 0.6%. But that is where the numbers stand now, as of now. So this is the sectoral price performance. What we have highlighted, three shaded charts, three shaded areas. It is basically three sectors where we are looking at, on a 3-year basis, numbers or returns are positive, and also on a YTD basis, numbers are positive. X of auto, metal, and bank on a YTD basis, as you can see, all other sectors are, trending negatively in terms of returns. Story is no different even on a 1-year basis. So now the question is, this is what happened over the last 1 year. Obviously, one of the reason, as we saw in the first chart, was that FY25 earnings growth was a single digit, very low single digit, 1 to 3% earnings growth. So to that extent, I think the price performance across the sectors is largely mimicking the earnings growth. Now we need to see how things pan out, going forward, or what are the expectations which are built into the earnings going forward. So I think before that, on the flows front, I think I'll not spend too much time. But if you look at the bottom right chart, so we are seeing the last 2 months where, FIs are once again selling after, buying, which happened from March, April, May. There was a positive number from FI, but on the June, July, and August, we are seeing the negative number. But at the same time, if you look at the blue bar, there is a positive traction which is happening, mainly driven by the domestic buying. FI ownership already is at a multi-year low. If you look at the bottom left chart, now roughly at around 16% versus a historical high of 20%. Yeah, I think this is very important to note. While, we have looked at how the earnings have been, FY25 was weak, but now when I say that, second half of this year we expect, consumption to come back. So what are the various things, which we, because of that, why we believe the consumption should come back. So let's look at few things which government has done. So first, on the RBI side, there has been a quite decent monetary support from the monetary front, quite decent support. So to that extent, we have seen liquidity coming back into the sector. On the income tax front, already it was announced that below 12 lakh rupees there will be no income tax. Then some various cash transfer schemes which are being across the various states. Eighth pay commission is expected next year sometime. While it is delayed to some extent, but nevertheless the effective date will be there early in the next year calendar. GST, I think it's a matter of few days where we'll see. Already it has been announced by Prime Minister on the 15th of August. So to that extent, there will be announcements, and hopefully we should see positive traction, particularly on the consumption front because of this. Now, if you look at various management commentaries, we just tried to highlight a few before coming to annual earnings for FY26 and 27. So, if you look at few sectors where let's say look at first on the OEM auto OEM side. So the auto OEM management expects, a decent mid to high double digit growth on the SUV front. Or if you look at real estate players, they expect, steady growth going forward. Or if you look at hospitality sector, there again there is a decent growth. So I think there is a lot of hope, there is a lot of positivity which we are seeing across the sectors. While we know, that 1Q FY26 was not that great, it was still a higher single digit or 10% growth, but nevertheless I think there is a lot of hope which is being built in, that coupled with, what government has done, what we saw on the previous slide. So to that extent, now then let's look at FY26 and FY27 earnings. So this is what we have looked done. This is a summary of Nifty 50 earnings sector wise. So if you look at FY27 last column, I think barring the export oriented sectors like, let's say, or global sectors like pharma, oil and gas, and IT, X of that, all sectors are showing a decent or higher double digit growth. Overall, if you look at FY26, earnings growth for Nifty 50 companies is roughly around 8%. And on FY27, the growth is 15%. So clearly, versus a subdued FY25, we are looking at hopeful FY26 and, a decent good growth in FY27. But obviously, one needs to look at valuation. Now also let's look at valuation. So here I think left hand side is a Nifty 50. So Nifty 50 roughly on a 1 year forward basis is trading at a long term average. On the right hand side is mid cap. Obviously it is trading at premium. ROE, if you look at Nifty 50 companies, now has come back from a lower, higher single digit. Now it has come to a decent double digit. But clearly, I think the takeaway is that Nifty 50 companies, or the large cap as a pack, I would say, is trending at long term averages now. Yeah, I think to summarize, 1Q, was obviously, as I said, was better than expected. We do expect, second half to be better, driven by the base effect and various things which government has done. On the macro front, I think there is a clearly unison in terms of fiscal as well as monetary policies. Tariff obviously is a near-term hiccup. Let's see, we are not seeing the end of it. There may not be, remapping of global trade, but yeah, it's a evolving situation as of now. From the domestic growth point of view, clearly there are multiple levers which are there, as we just listed out out there: consumption, digitization, I'll not rate all, but there are multiple levers which are very much there from the India growth story. India definitely stands out vis-a-vis a lot of other countries, driven by its demographics, political stability, spending on the infrastructure, and continued reforms. Valuations, I think, yes, large cap, as I said, is trending at long term average, while mid and small, is premium to long term average. But again, rate cut to some extent is supportive. One needs to stick to bottom up approach, at the current juncture, given the valuations. What we support is anything we do prefer, funds like large cap, flexi cap, multi cap, and clearly hybrid funds, obviously, given the market volatility. But from the investor point of view, one needs to follow a disciplined asset allocation approach. So yeah, I think what I'll do is take a pause here, and yeah, we can open up for questions.
Thanks, Harshad. Thanks for a very insightful session. Participants, in case if you have any questions, you may feel to put it on the chat box and we'll try to address most of them. First question that has come from the participant is what kind of impact the proposed GST reforms would have on the overall consumption side, if you can elaborate, Harshad.
Sure. So as of now, I think it is more, what we are expecting is more driven by the media articles or tidbits, what we are, hearing. But I think what we understand is that there is some room. So if you recall, when the GST was implemented, so there was some 5 year guarantee in terms of GST revenues, which was given to the state governments. So to that extent, I think that period ends. So there is some room to start with of at least $20 billion is number what we understand from the government. I think that is the initial uh, you know uh, to the extent of let's say 1.6 to 2 lakh crores kind of incentive, so that there is which could happen through these GST reforms which we are currently talking about. But which sectors, how much it could happen, rate rationalization has already been spoken about. But I think sectors which are being talked about is primarily, auto, cement, wherever there are higher rates. So there is the expectation. But yeah, I think uh, let it come out, let the government spell out what they wants to do, and then one can really assess the impact. But I think the bottom line is the number is big, so to that extent, it should spur the demand, whichever segments or sub-segments, the rates will be reduced.
Sure. So while overall impact would be positive for sector specific, we'll have to wait for the fine print to come. Harshad, the next question is from what is your view on IT from an investment perspective, even though the outlook remains bleak given the tariff situation in US? How do you see if someone has to invest into this sector, would that be a prudent call at this point in time?
So on the IT, there are two, parallel things which are going on in IT. One is the near-term issue in terms of demand, which is kind of, the decision making is delayed because of this tariff and all. And the second is obviously impact of AI, right? There are two things which are parallelly going on. So first, I think on the near-term demand, I think till the time there is some distant clarity on the tariff front, one should not expect too much on the new projects being announced. So to that extent, I think whatever is happening right now in terms of subdued growth, that will continue at least for the another quarter or two. Beyond that, I think as that clarity on the tariff comes out, we do expect the normalization to happen in terms of the new transformational projects been awarded. But till now, it's more about cost cutting projects. While ticket size is large for the cost cutting projects, but the point is the duration is smaller. So that's the issue. On the AI front, I think while it is being talked about, and if you look at IT sector over the last 15, 20 years, so they have gone through various disruptions time and again, but to that extent, they always evolved in terms of their business model. So this time again, also we do expect evolution on the business model, but I think the bottom line is valuation, right? So valuation, if you speak, unlike other sectors, I think valuation still trends at a long-term average, I would say, not premium. Secondly, as I said, whenever there is a rate cut which happen on the US side, IT sector to some extent do benefit in terms of some marginal re-rating which could happen. So I think if you look at our position, we are roughly, I would say, marginally underweight on that sector, given that we know that near term, even we are not sure how things would pan out. So from the sector call point of view, one needs to wait till the clarity comes out, hopefully by the end of this calendar year. But valuation, as I said, are not that rich. One can take some reasonable, position in the sector, which we are doing.
Sure. So, Harshad, while FPIs were for a brief while for 3, 4 odd months positive on India and then again have turned net sellers. So, what is your view? What is there something that domestic investors are not able to interpret and FPIs are aware of and kind of they are being bearish on India?
No, I think for FPIs, it is more relative call, right? So if you recall the earlier selling which happened in September, October last year, it was more driven by valuations. They again came back somewhere in Feb, March. I think again because the valuations were started to look better. Even recently, I think whatever selling has happened, it was again driven by multiple factors. Where, as you recall, during this period, U.S. market also again kind of bounced back. For them, it's a relative positioning which they are doing. So I think not too much to read into this short-term buying and selling. At a overall level, they still continue to hold, let's say 16%, 15, 16%, which is a decent number. But for them, like we look at valuations, they also look at valuations. The only difference is for them, it is not only India, they can move money away from India to any other, countries. So if you look at countries which have done well on a YTD basis, so Europe, many countries in Europe has also done well. Few countries in South America has also done well. So it is for them, it is more about relative, positioning. So if India again, from the traditional approach, valuations again start looking attractive, we will not be surprised if, again money comes back.
Sure. So two, three questions. I'll try to combine all of them in one. So one is, what is your outlook or if someone has to invest into mid and small cap space at the current juncture? And how about thematic funds? Which themes currently one may look at from a longer term perspective? And which segments currently, in your view, are reasonably valued from an investment perspective?
Sure. So let's start with mid and small. So I think between mid and small, I would say at this juncture, I would prefer small over mid, given the relative valuations between the two. But having said that, I think so the point is if you look at history, right? Let's take our 20-year history. So on an average, large cap, we have seen 12, 13% return, mid cap, let's say 14 to 15, and small cap, let's say 16 to 17. That has been the range over the history. So right now, given the valuations where they stand, the only difference I would say is that one needs to keep a longer term horizon for them to make money in that segment for mid and small. It's not that no go area or something like that. It's more about, I think, the time horizon has to be slightly longer. Second, on the thematic, I think what you asked, I think typically the way we do in stocks, right? Something which is not doing well but still has a potential to come back, mean reversion. Ideally, one should look at those sectors rather than going after the sectors which are doing really well. So I think in that context, I think consumption is one theme which I can think of has not been doing well for the last 1 year or so. Clearly, there are different initiatives which government has doing. So there is a lot of hope in terms of consumption coming back. I think that is one theme which I believe one can look at. What was the third question?
Yeah, so theme and overall segment wise, what are the segments that look reasonably valued?
So I think uh, reasonable valuation. I mean, just a headline level, if I can say, financials are reasonably valued. But now I think it's not about unlike let's say 1.5, 2 years back, one could have taken a top-down approach, where one could say that this sector is looking good at aggregate level, that is looking good. But now I think it has become more stock specific. So while at a headline level, sector might not look that attractive, but within that, there are one or two companies which will you find attractive. Or there could be some sector which is not looking attractive, which is attractive, but that what I'm trying to say that one has to be stock specific here and not bottom top down approach at the current juncture.
So, Arshad, since you talked about financials, so one of the concerns is since whenever there's a rate easing cycle, the margins of the banks tend to come down. So, from that perspective, how do you see this panning out for banking as a sector?
Sure. I think that's always the case. The NBFCs benefit and banks, that there's a NIM pressure. But it is not because, something of timing mismatch, right? Because whenever the rate cut happens, so the banks have to reprice the loans immediately because, it's a rate linked, repo linked or, something like that. But give it time of let's say 1 to 3 quarters depending on what liability profile each banks had over the 1 to 3 quarter period. I think eventually everything gets passed on and then the NIMs revert back to the original loan mix. So already we are done with, I think, almost 1 to 2 quarters are done. I think in the second quarter this year, looking at and also listening to various con calls of banks, looks like the second quarter will be bottoming out of the names for the banks, and we will see names improving in the second half of this financial year. It is more about mismatch of asset and liability in terms of passing the lower rates.
Sure. So, another question is, what is your view on power and logistics sector? If you can just give some highlights on that.
So power basically utilities, as we showed in the chart, on a YY basis, there was some decline, some moderation in the power consumption. But on the power side, what is happening? So there are two things which are happening. One is there is a lot of focus on the renewable power, so as to on the wind or solar side. And if you were to look at the capex, a lot of capex is also happening on the transmission side. As I said, almost to the extent of I think 9 lakh crores by FY32. That the kind of projects which needs to be done here. And from the sector earnings point of view, because a lot of earnings are ROE driven earnings, so to that extent, even if the, even if the power consumption is lower, the company's earnings don't get too much impacted. But I think from the valuation point of view, utilities I think are decently priced vis-a-vis earnings growth expected. Not worried too much on that front. Uh, on the logistics front, I think it's a broad-based sector. One cannot really say because you have road logistics, you have rail logistics, you have port logistic companies. So I think different sub-segments within that. I think as and when we would see private capex coming back, we would see some sanity on the global front. Then we'll again see volumes coming back for this logistic companies. From the next 6 months to 1 year, I'm not too sure, but over the 1 to 3 year period, I would say there is a decent volume growth which could happen on the for the logistic companies. But valuations again, I mean, can't answer in a 1 or 2 sentences. It is more, there will be many sub-segments, within that.
Sure. What is your view on capital markets and wealth management firms? While you alluded that valuations look very expensive at this point in time, and broadly you are underweight across your portfolios, if you can just share your views on this segment.
No, so capital markets, so we do have, few 1 or 2 names in our portfolios. I didn't make a comment that we are, under weight on that side. So we do have weight out here. But I think within that, I think both, I would say, are richly valued, if I recall at the top of the mind, valuations where they are trading at. But I think at the same time, one needs to look at, in the view of, financialization, where we stand in the financialization journey as a country. So, there is a huge underpenetration out there, be it on the wealth management side, be it on the capital market side. While there are headlines made for different reasons, and, on the capital market side, also historically, there is a lot of cyclicality. But if I were to take a, 3 to 5 year view, I think there is lot of room to grow in both these segments. So yes, one needs to back a right player, one needs to back a ethical player. I think there is a decent growth opportunity out here.
Sure, Arshad. Thanks a lot for addressing all those questions. We don't have any additional questions, so would like to request you for your closing remarks before we close this webinar.
No, I think that's all from my side. I think, yeah. Thank you. Thanks.
Yeah, thank you, Arshad. Thanks a lot for this insightful session. Thanks, participants, for joining into this webinar. We continue to look for your participation as we keep on doing this webinar. In case if you have any feedback, you may share with us. And in case if you have any questions further related to this webinar, you may get in touch with our relationship managers. We'll try to address those. Thanks a lot. Thanks for joining in.